Many pre-retirees might not realize it yet, but one of the biggest tax implications that I see hit during the retirement years is that of required minimum distributions. You might have spent years or even decades saving in your pre-tax accounts, letting those investments grow tax-deferred over time, and one day the IRS comes knocking and says it's time to pay up. You have to withdraw certain sums of money whether you want to or not. The catch is, every dollar withdrawn adds to your ordinary income on the year, and this can eventually cascade into causing things like increases in Medicare premiums or higher amounts of Social Security being taxed as well. That's why I feel it's imperative to make this video today, because I'm going to explain exactly what RMDs are, when they may start for you depending on your date of birth, how they could end up piling up and snowballing to very large sums of money over time, and the exact strategies that you can consider to hopefully mitigate these tax implications in the future. And stick with me, because at the end I'm also going to cover the new 10-year rule due to the Secure Act 2.0 and what that might mean for those of you inheriting IRAs or when considering passing on a legacy to your heirs. Let's start with the basics here, because when it comes to RMDs, I see a lot of half-truths or misconceptions as far as retirees' understanding is concerned. First things first, if you're born between the years of 1951 and 1959, your RMDs are set to begin at age 73. If you were born in 1960 or later, however, those RMDs are going to wait until you reach the age of 75. And this is important to understand because it creates two distinct buckets of retirees when it comes to planning for income in the future. So why does the government require RMDs at all, you might ask? Well, it all goes back to how these traditional retirement accounts are structured. In the case of individual retirement accounts, you might have received a deduction for your contributions over the years, and those accounts ended up growing tax deferred. In the case of an employer-sponsored plan, both you and your employer received a tax deduction for contributions, and those accounts also grew tax deferred until the time when you have to withdraw in retirement. And when that time comes, the bottom line is the IRS wants to collect on some of that growth in the form of taxes. The way the actual calculation works with regards to RMDs can also be important to understand, because first and foremost, it's not just a flat percentage across your lifetime. In addition, it's not optional. Each year, the IRS looks at your previous year pre-tax retirement account balances, and that number is then divided by a lifetime expectancy figure published on their annual tables. Earlier on in retirement, in your early 70s or so, that number might be closer to 25. So your RMD equates to roughly 4% of your year-end balance. But as you age, that divisor declines, and the amount that you have to withdraw on an annual basis could end up increasing quite dramatically. And the bottom line is, if you don't take the money out, you could end up facing stiff penalties of up to 25%. Another misconception I commonly come across is that first RMD that you withdraw is what you can expect throughout your lifetime. The reality of this is, the RMDs tend to grow over time in many cases because the fact of the matter is the divisor declines and the amount that you have to take out increases regardless of investment performance of your account. This means that RMDs can end up being both unexpected and dynamic, and they can change whether you're ready for it or not. So be prepared in understanding what's going on in your situation. And although it might sound pretty bizarre, I have seen many instances over time, especially as of recent, where these RMDs compound and snowball and end up pushing folks into higher tax brackets. So as I stated earlier, when you begin your RMDs, whether for you that's ages 73 or 75, depending on your date of birth, that number could be about 4% of your total account. But by the time you reach your mid-80s, you could be looking at a percentage closer to 7% of the total value. And as you push into your 90s, this number could end up surpassing 10% of your balance. And that's where people can get caught off guard, not having a full understanding of the potential tax implications in addition to the added potential expenses to Medicare via IRMA or increasing the taxation on your Social Security. So say today you're starting to take your RMDs, and although it could be a modest amount, fast forward 10 to 15 years when your spending could potentially be on the decline. However, the IRS is telling you to take more out. Again, this is a situation where unexpected tax consequences could have implications for your retirement planning. And it's also important to note that these withdrawals are not treated as investment income like dividends or capital gains. They're added to your ordinary income for the year. And when it comes to additional expenses, for those of you who are unaware as far as IRMA is concerned, this could end up causing thousands of dollars in additional premiums for Medicare Parts B and D. And while we're on topic, as far as Social Security is concerned, once your income passes modest thresholds, you could end up paying taxes on as much as 85% of your Social Security income annually. In my mind, a less than desirable outcome and progression looks something like this. Your RMDs increase year over year. They end up pushing you into higher brackets across the board. Your IRMA payments start kicking in and increasing your premiums for Medicare Parts B and D, and now you owe more tax on your Social Security as well. This situation is essentially a chain reaction, and once it gets going, it's not that easy to reverse. So this brings me to my next point. What do you do about it? Well, if you wait until RMDs kick in and fly blind, you might not have too many different courses of action that you can take over time. However, with proper planning, there are strategies to consider, if applicable to your personal situation, that could help lessen the blow. And the crucial time period where this occurs are the years between retirement and when you start your required minimum distributions. This potentially golden window could allow you to think about repositioning assets, managing your taxable income, and creating a strategy which could help you lessen the blow and stabilize those RMDs as you move to and through life. I like to think of this as trying to reshape your current and future income, so when the time does come that you might have to take those RMDs, they could in theory be more manageable. And two of the most impactful tools I've seen for this are considering Roth conversions and qualified charitable distributions. So let's start with Roth conversions, because I feel like a lot of times they are misunderstood, and I've seen in many instances that they actually could end up being a game changer. A Roth conversion is where you take money out of a pre-tax retirement account and convert it to a Roth account. At that point in time, you will have to pay taxes on the money that is moved over. And although paying taxes now might seem like a tremendous burden, once inside the Roth, that money ends up growing and compounding tax-free, and any withdrawals taken from the account, provided you meet certain guidelines, is tax-free as well. Another little important note, unlike pre-tax retirement accounts, Roth retirement accounts do not have required minimum distributions during your lifetime. So why does all this matter? Well, if you can create a strategy and put it in place to convert pieces of your traditional pre-tax retirement accounts to Roth over time before you reach RMD age, you could end up lowering the balance substantially of your pre-tax accounts, in which case the RMDs could also be less. A smaller pre-tax balance, in theory, could end up leaving you with a much smoother transition as you move into that RMD age. In addition, you could have more of an idea of how you could pay taxes and smooth out your lifetime tax implication over time, paying with intention as opposed to waiting to the IRS to inflict that upon you. And why this timeline is so important? Because also in theory, during those years between retirement age and when RMDs start, your income overall could be less than it was during your working years. By strategically converting to Roth during those years, you could end up keeping yourself in a relatively low tax bracket in comparison to where you could be years in the future. So let's look at this in practice. Suppose you retire at age 64. Between the years of 65 and RMD age, your income could be less. In addition, throw in the caveat of delaying Social Security until age 70, and now you're at a lower bracket than you might be otherwise. But instead of barely paying any taxes at all, you choose to convert portions of your pre-tax retirement accounts to Roth over time. Again, potentially using a method known as bracket filling, where you're choosing to stay within certain thresholds so you don't propel yourself higher as far as taxes are concerned. In addition to these factors, if you're considering legacy planning in any fashion, have an understanding that your heirs would now be able to inherit a tax-free account as well. Another caveat I like to take into consideration when going through modeling these Roth conversion ladders is if one has cash outside of their retirement accounts to pay for the potential tax implication associated with the Roth conversion. So in essence, I like to look at it as a balancing act, with the goal of converting enough to make an impact, but not so much that you could create a tax implication earlier than you might have expected anyway. Now let's switch gears for a moment and talk about qualified charitable distributions, also known as QCDs, and a strategy a little lesser known to retirees in my experience. Once you reach the age of 70 and a half, you are able to take out money from your retirement accounts pre-tax and contribute them to qualified charities. At this point, the money does not count as income, but rather is deducted from your income for the year. And the brilliance here is that the money never actually gets added to your AGI, but rather it goes directly from your retirement account, pre-tax, to your qualified charity of choosing. So why is this such a big deal? Well, in some cases, I've seen that retirees like to give to charity, and oftentimes will do it via check or credit card. And then at the end of the year, they will try to get the deduction on their taxes. In this instance, moving the money directly from your pre-tax account to the qualified charity allows you not only to have that money taken off the top as far as your income is concerned, but it can also satisfy a portion of your RMD. And that number for 2025 is up to $108,000 for the year. A quick example here, if your RMD for the year is $100,000 and you opt to move $50,000 via QCD to a qualifying charity, the government only sees a $50,000 hit your income. Now, when we talk about RMDs with our clients during review, we're not only talking about our lifetime in many cases. One of the biggest potential burdens that I see time and time again, specifically due to the rulings in Secure Act 2.0, is how these taxes could impact your heirs when they inherit your retirement accounts. Before the rule change, beneficiaries were able to spread out those RMDs across their lifetime expectancy. But now we have something known as the 10-year rule, where the entire balance of the account has to be drained by the 10th year of their ownership after inheritance. And to be clear, this rule is only applicable for non-spouse heirs. And the reason that it could be so impactful is because in theory, whether they're in their 40s, 50s, or maybe even 60s when they inherit those accounts, they could end up being in their prime working and earning years. So let's picture a non-spouse beneficiary earning a salary of about $200,000 a year. They inherit a $2 million IRA, and they have to drain that account to the tune of $200,000+ a year for the next 10 years. Not only is this massive additional income in their situation, but it could also propel them into dramatically higher brackets as far as taxes are concerned. And an important wrinkle to note here, if they were to inherit a Roth Benny IRA, although they would have to take that money out over the course of 10 years, it wouldn't be added to their taxable income. So when looking at the big picture, this is where Roth conversions can end up being a quite powerful legacy planning technique. By voluntarily paying the taxes at your tax rate now, you could end up saving your heirs tons of money in the future. And if you're in the process of tax planning prior to year end, check out our next video here.